Generally, I mean, I also sell options premium, so I'm for the most part net short the whole time. So I kind of like that, like a little, net delta short. But on the S&Ps, remember we talked about panic. Well, when there's panic on the upside, I mean, it's generally short covering, so you can take advantage of it. But really, the true panic is in down markets, is when you know, maybe there was a pop in the morning and all of a sudden, like, what the heck just happened? And
Yeah.
there's a fire in the movie theater. That's kind of really where my sweet spot is. I don't wait for that only, but yeah, that's kind of my style. I like to see. I don't want to see just price movement, like I mentioned, like failure. Where are the sellers, where are the buyers? I want to see where there's a group that were just smiling, all of a sudden their face turned to frowns, like, or uh-oh.
That's an
That
interesting
I
way to
want to
put
take
it.
advantage of, because that's the thrust that's going to get me to my T1, my T2, the trailer. It's not just about I don't want I'm not that good at price movement. I mean, if you ask me what stock was going which way, I'd be 50% correct historically. But if I know there's a catalyst behind there where someone's going to panic, or a group that just, I know what they're looking for. I know what they want. I know what their target was. And when it didn't hit and it goes the other way, I want to take advantage of it.
Hey everybody, welcome back to another podcast episode. Today I am joined by Michael Toma, who is an experienced trader. He's a trading coach, and he has a lot of experience in something that we all need a little bit more of, some risk management in our lives. Michael, welcome to the show. Thank you for being here.
Thanks, Nick. Great to be here.
I'm happy that you made it on, and I followed a little bit of your work. I've really enjoyed some of your podcast episodes that I've seen on YouTube before, and I would love it for those of you who don't already know you in the audience. Can you give us just a little bit of a brief overview of you as a trader, you as a person, however you'd like to answer it?
Yeah, sure. I mean, I've been trading for a while now. I don't want to say how many years, but I was kind of one of the original SOES bandits. But back then when tech was really, kind of in its infancy. But a lot of my work, really, how I developed into being a trader, was really my corporate work, my corporate risk management work in the corporate field. And I always had a fascination for the markets. And I said, I could bring risk management, these principles, these are really core principles that apply to a lot of things. I can carry them over into the trading space. And I think I might have an edge that, others may not have. And obviously it took a lot of refining and building as a trader, but that's really how I got my start. And I kind of never really looked back.
Fair enough. And so you tell us a little bit about your corporate background in risk management. What was that like? Where'd you get your start? And
How did
Yeah,
you find
mostly, yeah, sorry, mostly in finance companies, insurance companies. So I did a lot of, auditing, things like that, which a lot of those skill sets really, was brought onto trading. But right around the early 2000s, a lot of legislation was passed, the Enron debacle and things like that, where the concept of risk management was really needed from a compliance standpoint for these companies. So I became sort of in hot demand. But then this other breed of risk came into play, which is called enterprise risk management, where a lot of this risk management is like limiting losses and surviving to survive the next day, even in the trading world. But enterprise risk management brings it into the world of, hey, wait a second, can we take these risk principles and sort of add to the bottom line? It's not
mm,
just about preserving capital; it's about optimizing P&L and optimizing efficiencies. So that's really where it opened up. And thanks to a lot of US legislation. And I took it, I kind of ran with the ball. No one really knew how to do it. So I was one of the first few to get certified and take it really to hand. So mostly insurance companies, finance, some Wall Street banks, and then kind of work my way from there.
very cool. So you went from the corporate world. How did you get involved in trading? How did you find trading? And what principles, I guess, did you rely on bringing your background into trading with a risk management background like that?
Yeah, yeah. Well, I always had a fascination for the markets, even when going through university. I was always fascinated by it. Even with no technology, I just was really just immersed in the fact that this element, this thing that moves, you can really profit from it. Obviously, little did I know, but I was always fascinated with that angle for where news can generate movement, and movement has a profit edge to it.
mm,
When working in the corporate sector, and I love the people. I love, it's a great life in the sense that, I enjoy the workspace. I enjoy having people come into my office saying like, hey, Susie's dating Tommy over in accounting. And, I kind of like that lifestyle. But at some point I realized this is not going to be my legacy. I really
Mm.
want to do what I love to do, and that's trading, and at least giving that a shot. And I actually went back, Nick, a few times. I mean, I went back to corporate life, tried trading, went back again. um it wasn't like I blew a lot of accounts. It just was, the money in the corporate space was too good. It provided a lot of security. But
Oh,
there
for
comes a
sure.
time in your life where you just, what, you start thinking about legacy and say, what, I'm going to take a chance. And by the way, those those employers that I had, they were my first consulting clients, and I still have them to this day. So one of the cool things about trading is you can do other things. You just don't have to go full step. You can
Yeah,
do consulting, and I felt that transition, which I find a lot of traders don't have that luxury, was a big positive foundation to allow me to get to the next step in trading.
Definitely. I mean, and that's the cool thing too about trading is like the flexibility of time really is a thing for even myself. I've been trading for about 6 years, 6.5 years, and at this point in my trading only takes me maybe an hour and a half a day. It's not like a long period of time that I have to dedicate to the charts. I'm not grueling over a 5 minute chart or anything like that. Like I'm just kind of I set up my trades, I do my thing, and I walk away. So with your jumping back into corporate world, doing other ventures, I totally understand that too, because of course in my world, I'm also, you have all this extra time to sort of go to do other things. Now, when you say, obviously, clearly with your background in risk management, you brought it to your trading. Tell us a little bit about how, I guess, a risk management focused trader approaches the market. Like, how are you protecting your account? What does risk management mean to you, and that sort of thing? Like, how do you approach it?
Yeah, well, the biggest thing, and this is applies really in the corporate world as well, and this is how I learned that, you know, in the early stages of risk management, and where you're taking your certifications, a lot of this is about protecting loss, protecting assets. In a
hmm
corporate world, it could be anything, reputation, physical assets. But really, when in the enterprise risk management world, which is really about optimizing success, optimizing goals, it's that really door that opened up where I said, these principles of risk management, which is basically you identify something, a chance of loss, you assess it, what the impact could possibly be, and then you set controls to mitigate or control that potential exposure. Well, I just talked about the corporate world. Aren't those the same principles that we do when we're trading, or at least we should do? Right? Identification is one of the most critical areas because you can't manage something or control something that you don't identify. So, really playing a role in help identifying whether it's corporate risk, and of course, in the trading world, exposures there brings a whole new level. The key point I want to make, and the key takeaway I think for your listeners, is this enterprise risk management approach. It's not just about stop losses. Everybody's so concerned about where do I put my stop. Think globally. Think about your trading career. What's going to put that at risk? Is
hmm
it skills? Is it education? The number one exposure that traders have quite often is, and I've written about this, spousal risk. It's, what? The nearest and dearest that you love doesn't support your venture or doesn't
hmm
understand it. Well, let's assess that and let's control that. Make them part of the success part process. Make them part of the reward process. That's really what risk management is about, not about stop losses.
Yeah, that's so true. And there's so many different angles of risk. And then also thinking about like opportunity cost and like what you could be doing, and how much capital do you really need to make a reasonable hourly payment per se, relative to the risk that you're taking. Because a lot of traders, they quickly realize that having a $1,000 account is going to mean not making anything if they're risking properly. So they decide to leverage up and risk way too much. So I'd love to. So you mentioned obviously stop losses are a pretty straightforward risk management model. How, in terms of like percent per trade, max drawdowns, sort of the more technical terms, would you recommend traders think about? Like what specifics in terms of like uh, components to a trading account? Like how much capital do you need? What risk per trade, max drawdowns? Like how would you recommend a new trader think about all those things?
Yeah, I think they need to look at it differently depending on what phase they are in their journey.
hmm
And if they're in the development stage, I mean, what we really want to see is if you have small capital and you're willing to just learn by it, considerate tuition. Well, risk of ruin's a great metric that I always like to assess. But
Hmm.
if you're going to blow a $500 account, I'd rather you learn something from it, a skill set that's really going to help you bring to the next level. Of course, if you have a account that's much bigger or much bigger impact to your life, we need to look at risk of ruin. So I'm not a big fan of these 1% per trade or half
Hmm.
percent per trade. What I want to see, and when I do journal audits, I want to see what's that risk of ruin. I want to see it like point one of point one. Who
Yeah.
cares about making money? Let's focus on learning the business, learning how to be successful. One of the things, Nick, and you know this too. I mean, you've been trading for a while. The most beautiful benefit of this business is scalability.
Mm.
There's plenty of time to scale up.
Yeah.
Let's learn the core basics, right? Don't you agree?
Oh, absolutely. I think one quick thing too is like, everybody is so concerned with how much money they can make, and when you actually truly, I mean, I spent like 3 or 4 hours this weekend just back testing concepts, and one of the things that I was actually looking at is exactly what you're talking about, risk of ruin, where I was literally saying like, how many trades, how bad would it have to get me to a max drawdown of, let's say, 40%. Like, what's that probability of it happening? And what you quickly find is that the smaller you risk and the more room you give yourself to build back a trading account with something that has some sort of edge, the better off you're going to be. But I think so many traders, they get so caught up thinking about like, well, how can I make $1,000 a month? How can I make $5,000 a month? Like, that's their focus. And you might actually be able to build systems that do that. But like you're saying, what is your risk of ruin and how long can you do it before you run into some serious trouble? And one thing I would add too is, like you just said, like, forget making money for a little while. That is so powerful, because if you just taught yourself to trade with tiny size and risk so small, and just learn for a while and very slowly scale your size up and scale your approach up, I feel like that's such a way I wish I had approached trading to when I first got started with it.
Yeah, and how did we learn, Nick? I mean, we made all the same mistakes too. I
Of
mean,
course.
that's how we did it. And some of us we paid dearly in tuition. We talk about risk of ruin, or managing so much, what percent per trade. Think about, if don't worry about the money so per se. Keep it as small as possible. Learn, build, and develop. Really, if you're risking 1% per trade, or even 0.25, and you have a negative edge, or you haven't identified a particular edge, I could tell you what your risk of ruin is. It's going to
Hmm.
be 100. I
Yeah.
mean, it doesn't matter. So really, building your skill sets, obviously building some muscle, discipline, risk management, and there's a lot to it. But once you get that edge, really, it's just about rinse, wash, repeat. There's your risk of ruin. If you can get that edge, now it's the question of, can we execute with compliance? And the quicker we
Yes.
get to that compliance, now you're just a machine. You're the restaurant on a Saturday night having people coming in and out, sitting at the tables. The margin's there. Now we just have to focus on execution. So rather than focus on how much should I risk, where should my stop is, important things, don't get me wrong. But let's focus on getting the tactics in place, getting an edge. And now our job is not a trader, we're a project manager. We're a
Yep.
project manager who's just executing a plan.
Yeah, that's so true. And this morning I was on my live stream and I was saying something sort of similar. I mean, you're basically like running. I use the analogy of like running a store. Like, as a store owner, your job is to buy inventory, put it on your shelf, and wait patiently for setups, or, well, I'm jumping analogy. Wait for a customer to show up to buy your inventory, which is the same thing as a trader. You're like, it's mostly patience, it's mostly waiting, and risking small. You're not exposing yourself to so much risk on one particular trade. But as traders, if you're gonna make money, you get paid to wait and you get paid to risk properly. At least that's my opinion. I don't know if you want to add to that or if you agree with that, but that was what I was talking about this morning on my live stream.
That's really it. I mean, we're basically, like I said, project managers. We're task owners. Say,
Hmm.
here's this plan, execute it. But when you think about to go back to the restaurant, when the young couple comes in on a Saturday night to a fancy restaurant, you know, they're probably going historically, that type of couple orders drinks, the nice menu, the whole bit. So when an opportunity comes like that, am I going to say sorry, you can't come in? I mean,
Hmm.
if there's a trade opportunity with an expected positive outcome, so I hear a lot of, well, I didn't feel comfortable, or I don't know, it just didn't look right, or of my 100 indicators I watch, one of them wasn't looking good.
Mm,
No, this is a positive expectancy. You should be taking that every single time.
mhm,
Yeah, that's actually so. I want to ask you about that, which of course, risk management is one half where it keeps you in the game despite having, even if you do have an edge, if you have a quantifiable edge, if you find something in markets that works well for you, risk management keeps you in the game in case just because you have a probability in your favor doesn't mean, of course, obviously, that it can't go against you for a while, right? You could have a 60% probability and still could hit that 40% 10 times in a row. It's still of course, possible to do so. You mentioned quantifiable edge, finding some sort of edge in the markets. This is a loaded question, of course, but how would you recommend newer traders to find and sort of realize that they have a potential edge in the market? What approach would you recommend?
Yeah, and how much time do you have? But yeah, there's a lot of nuances to it. One of the things I always like to harp on is, you know, I know everybody loves the indicators, and I'm not a big indicator guy. I know you're not crazy about them either, but
mhm,
it, it, it just, if it gets you engaged, fine. But get your hands dirty. But look at things, look at nuances, look at activity, and say, how many times does this happen during the day? How
mhm,
many times does this happen during the week? Or when this happens X amount of time. I think we're so focused on the markets, US dollars, just crushing it lately. And
mhm,
but really it's just movement of prices, movement of something. And if certain activities, really this whole job of discovering edge is kind of like one big if then statement. I mean, one of the strategies I use a lot is just, on a certain sort of point of control, how many times does price on average on a regular inside day does it cross the point of control? Well,
mm,
if it's 1 p.m. and it's only done it once and it averages 4.45 times, my mind, like a leopard in the desert, is starting to think, you know, attack. When is this going to happen?
yeah,
I'm just taking the numbers, so it's kind of like two turtles crossing the street in a sense. If I know one has won that race 63% of the time, it's the decision has already been made.
Yeah, that makes sense, and it's just, I mean, that as traders is so important too, as looking for pattern recognition. I mean, that's really the what I think attracts a lot of people, myself included, to the markets is like pattern recognition, understanding, observable trends in the markets and taking advantage of them is such a fun puzzle to piece together. You mentioned point of control on a inside bar. Can you break that down just like a little bit for maybe the newer traders or anybody who doesn't know what that is?
Oh yeah, I mean, I don't even have. I really don't use candlesticks that much. But say you have sort of a previous day's range, okay,
mhm,
and if price opens within that range, and it's chopping in say the first hour, well, obviously anything can happen. But let's let's go with the I'm going to go with, and again I'm going to go with, because I have historical data that says could probably lean to more of a choppy day. So I'm going to start playing, bounces, so to speak, within that
mm,
range, as opposed to going for like home run breakout type
yeah,
trades. So
yeah,
I've kind of used it as filters. Then I kind of look at some other nuances, and then kind of again, I'm waiting like a leopard in the Serengeti, just like waiting for something to happen, which gives me the proper edge risk reward, and then I just attack.
Very cool. Very cool. So I want to ask Michael in terms of a trading style. Do you have a preference in terms of trend following, mean reversion, or are you sort of flexible? Like you just kind of gave in that example where you like I'm mostly just looking for a scenario that I've seen played out and go with it. What's your generic like approach to the markets?
Yeah, yes, and yes. I
all
mean,
right,
we're trader junkies. I mean, but it
yeah,
really, what I'm looking for is where will the market be able to accommodate? I generally, just my sort of wiring, if I can say that, Nick, is I kind of like the reversion stuff. I
mhm,
like to take advantage of trader panic. I like to see failure,
mm,
and I know there's other traders looking to bail, so I want to be like on the other side, accommodating their failure. As sad as it sounds, but you know when markets are trending, and you get some FX pairs like USD JPYs, uh, I can't even think about reversion. I mean, it has to
Sure.
be trend or nothing. So I'm looking to see where the market will accommodate me with an historical, back tested or live, historical edge. And
Mm.
I have to, and one of the, I think the secrets of really being successful in this business is identifying. Remember, we talked about risk management, identification, assessment, and then control. Identification. Identify what market are we in and what my risk is. I'm in a market and then all of a sudden it shifts and changes like its mode. I'm okay with that. I'll take the stop. But if I can find a market that's going to accommodate a certain style, I want to sort of have that glove that fits properly. I don't want to start trying to pound round pegs and square holes. And you could tell, you've seen, Nick. I mean, where traders start to do that, it just is horrible.
Yeah.
I'm a trend trader. That's it. I go for trends, and
Yeah.
yeah, but if this has been a chop fest, so why are we doing that?
Yeah, no, no, that's a great point, and I think you could go down the whole rabbit hole of several different avenues. There, you mentioned different particular assets trade differently. Dollar yen specifically this year has been such an incredible trend following vehicle, and several other of the dollar crosses have been really, really good for trends. And then you have other ones that are a lot more choppy. I know I spent a lot of time just going over dollar Swiss, which historically has been incredibly choppy, just for the last decade or so. So there's different styles, different approaches that work better for different assets. And then you also touched on something else, which is kind of interesting. Um, you know, Rounding out your performance by having somewhat of a approach for both, right? Something where it's like, okay, the markets are reverting a lot and they're back and forth. Maybe you have a strategy that's doing that at one point, and another strategy that's more focused on breakouts and trend following. And I've watched one individual that he sort of has like a, and I love the way he explained this. His name is Expert Forex on YouTube. He's an older dude. He makes expert advisors and stuff, and I love watching his videos. Anyways, he talks about like having a portfolio approach even in your trading account, which sounds a little bit like what you're talking about, where you have different approaches, different styles under the same sort of roof, if you will, and it gives you a little bit of exposure to both. So you have styles that are sort of approaching both ways?
Yeah, I think. I mean, I know maybe I sound. I think you have to. I mean,
Yeah.
it's because now what happens is even if you're really disciplined, but your markets are not accommodating you, now it's
Mhm.
just you're sitting around waiting. And I'm not saying patience is an incredible asset to have, a skill set to have in trading.
Yeah.
But if the markets are providing an edge and an opportunity with this type of style, I want to be there. And actually, I want to be early. I want to be one of the early adapters. And that's okay if I'm stopped out because it may take two or three times. But once that, say on a reversion trade, once it starts to move, all right, now I'm not hopping on the bandwagon. I'm the driver in the bandwagon. And when everybody's, running out of the movie theater, I'm already hitting my first target. So I like to do that. But it takes patience, takes time. And again, you're kind of anticipating the identification of what will happen, again, based on historical norms.
Yeah. So how do you just to get technical for a second, how would you quantify or how would you find that separation between when a market is trending and a market is ranging? Because obviously there's many different ways you can qualify that. You could use moving averages, Bollinger Bands. How would you sort of specify when a market is leaning towards more of a trend following approach versus a mean reversion or back and forth trading?
Love that question, and this is one of the skills that I think I bring to the table, and I try to teach to other traders is it's failure. It's identifying failure.
Mm.
It's what should happen isn't happening. Right? I ask myself a lot, and I like I'm part of a Slack group. I'm always saying, where are the sellers? This thing is down. Where are the sellers? I mean, yeah, of course they're there all morning, but what, how come they're not pushing this anymore? What's
Mm.
going on? Again, I risk identification or enterprise risk identification in this case. I'm identifying something isn't going. And then what you try to do, and again, it's like the mind just goes to work is what's the other guy thinking?
Right.
The short guy who's short. At what point he's going to say, uh oh, and I personally, I mean, I don't use like indicators per se, but I love like things like Heikin-Ashi bars and stuff because
Sure.
it kind of sometimes the candlesticks can get too crazy. It's like a Christmas tree, at least for me. But when you start seeing things like, hmm, things starting to turn, failure to make new lows,
Hmm.
Heikin-Ashi bar is turning green. Like all of a sudden now, the hair on the back of your neck should be standing up, saying, "Look, there's a interesting situation. I have an historical edge." And here's the great part about this, Nick. When you're an early adapter, where's your risk? It's pretty good actually. You know where you're wrong a lot quicker. So I'm not too worried about win-loss percentage, but I'm worried about getting in. I can get out pretty quick if just hey, the sellers came back into play. But so that's kind of like that earlier adapter thing. I'm looking for failure. Failure is one of the key things I'm looking for all day in my trading.
And so when you say failure, are you talking about market structure, like for example, like a break of resistance in the case of what you're talking about there? Are you talking about candlestick patterns? It sounds like you're similar to me in this in the sense that we focus mostly on price action and market structure because I didn't hear any indicators listed in there. Is that sort of how you're looking for failure in terms of price by bar action?
Yeah, kind of. I mean, obviously, I watch your videos and stuff, Nick, and I got to tell you, it's almost like my twin brother that I didn't know about. Like, I'm like,
Nice.
scary how we think alike, you know. But yeah, like breakouts that fail, and like new lows, new lows. Okay, bounce back, comes back. Hey, it's struggling at the 50. It's struggling at the 618 fib. Like,
Yep.
shouldn't sellers be pounding this? Those are like those key nuance numbers. And then the other thing I think about too is again, like the people who go, uh-oh, if there's a lot of people who are short, I know there's a lot of people who are going to have to bail.
Mm.
That's what I need. That's like the catalyst, but I
Yeah.
have to get in. So I have to pick a spot to get in. But yeah, like failed breakouts, like kind of the intro type strategies that everyone learns and they think they know when they're wrong. Um, I want to be on the other side of that.
Yeah, no, I like that, and that's for me 101 breakouts or reversals is looking for just signals that all those. I like the way you put it, where you're like, okay, it's coming to the 50, it's coming to the 61.8, it's hitting resistance, but why aren't the sellers taking advantage of that? Like in the case of, it's a downtrend and it's pulling back. I love that because that is exactly how I would look at reversals as well, in the sense that, like, okay, well, if sellers are not hitting the clear areas where sellers are supposed to be strong, that could be an early warning sign where you're talking about a bigger reversal that could be coming. And I will say the best thing about reversal trading, in my opinion, is that like you said, your risk is pretty dang clear, right? You've got your levels where you're pretty much wrong, and you also have a lot of potential for a swing back the other way if you call a full move. So I'd love to ask you also. I know that we mentioned things like dollar yen and stuff like that. Do you have any particular assets that you personally like to trade reversals on more versus trend following? I know the yen crosses have been very good for trend following. What about reversals? Do you have any favorite pairs or markets that you look at?
Yeah, I do. I generally I lean more towards the futures markets as opposed to, the pairs. I just like the centralized marketplace. Particularly on the E7, J7, basically the
Yep.
same chart here. I mean, the exact same chart. So it trades the same way. But I just like the liquidity and just the centralized marketplace. For me, as far as those type of failures, I love the S&P futures. Nasdaq can be a little crazy. I mean, you could pay a big price just to be right. But and I think Nick, you know this too. Is after a while, you just get to know a particular market. You get to know a
Mm.
particular pair. You almost get like a feel, like the nuances that play into it. The S&P futures to me, that's my sort of bread and butter, and that's my go-to that I use a lot in my daily trading.
Fair enough. And that's one where you're looking to do a lot of reversal trading. Are you looking like kind of like looking for creative ways to buy dips? Is that uh, kind of how you approach it, or will you short the market? Do you go both ways? How do you approach
So,
Yeah, I'll go both ways based on certain filters, things like that. But generally speaking, when the markets are sort of they'll thrust a lot and then they'll sort of pause, like your typical P formation type thing.
yep.
There's a lot of movement in those pauses, a lot of tagging. I use a lot of market profile. That's kind of like one of my go-tos.
Hmm.
And when we're in like an inside day, it just bounces, like crazy. And I'm not saying you take each one, but you can play those little bounces and stuff. So I love where the S&P futures will digest, so to speak, big moves
For
and then
sure.
just resume the trend. Well, a lot of people in trend trading, they'll pause or maybe they'll have a trailer on that. To me, that's when I go to work. That's like, okay, now we have to sit up a little straighter now
Mhm.
during that pause. It's kind of I get paid for being bored, being boring. Boring is pretty cool though.
Yeah, no, boring in trading is good. I'd rather be bored than way too excited, because excitement can be good or bad. So for sure. So you like the S&P 500? I guess with this year has been so devastating for equities. Have you been finding yourself taking a lot more shorts in that sort of scenario? Or are you more, or are you looking for bounce plays within all of that sell off?
Generally, I mean, I've been. I also sell options premium, so I'm for the most part net short the whole time. So I kind of like that, like a little, net delta short. But on the S&Ps, remember we talked about panic. Well, when there's panic on the upside, I mean, it's generally short covering, so you can take advantage of it. But really, the true panic is in down markets. Is when you know maybe there was a pop in the morning, and all of a sudden, like, what the heck just happened? And
Yeah.
there's a fire in the movie theater. And that's kind of really where my sweet spot is. I don't wait for that only, but yeah, that's kind of my style. I like to see. I don't want to see just price movement, like I mentioned, like failure. Where are the sellers, where are the buyers? I want to see where there's a group that were just smiling, all of a sudden their face turned to frowns, like or uh-oh.
That's an
That
interesting
I
way of
want to take
putting it.
advantage of because that's the thrust that's going to get me to my T1, my T2, the trailer. It's not just about I don't want I'm not that good at price movement. I mean, if you ask me what stock was going which way, I'd be 50% correct historically. But if I know there's a catalyst behind there where someone's going to panic or a group that just I know what they're looking for. I know what they want. I know what their target was. And when it didn't hit and it goes the other way, I want to take advantage of it.
Very, very interesting. I mean, that's kind of combining price action with the underlying psychology behind it, which I love. Because it's like it's like if you're in a buy trade and the market's coming down to a level of support, you as a buyer, you're sitting there, you're like, okay, should rally here. And when it doesn't, when it starts falling apart at that level, you sit there and you're like, oh my gosh, maybe I should just close out of this so I don't lose anything else, right? Like that human psychology of watching a trade sort of fall apart in your hands. Is powerful, and knowing that that's what on average what a lot of traders are going to be thinking, and then taking the other side of the trade when those setups occur, that's a really interesting strategy. It's really playing into just the human emotion of markets and specifically price action. So I love that.
Yeah, and when everybody has a plan. Everybody has a plan, an entry. When this happens, I'm going to do it. And sometimes that plan sometimes gets into hope mode. you
Mm.
know, and that's kind of and look, how do I know this? I was on the other side. I mean, I was getting burned half my career, so
Yeah.
I know is to be on the other side. So when you get into that hope and pray, I know it's time to and that's where the edge really, to me, kind of
Yeah.
rises to the surface. So now it's just some more of a rinse, wash, repeat, proper risk management, scalability, things like that.
I love that. That's a really fascinating way of putting it. Looking for clear reversal, setups where basically people are seeing their trades fall apart, and that's just markets. There's nothing good or evil about markets. It's just participants. It's just understanding human psychology, and at the end of the day, that's what largely drives markets, especially during times like this where you have these super high levels of volatility and a lot of greed and fear in specifically the equities world as well. So crazy stuff. Well, I do want to also say, Michael, that with your background in risk management and your combination with technical skills, I'd love just to see your reaction or your response to how do you sort of tie them together. So if you have an idea where, okay, a market is it's starting to reverse, it's showing failure at a level, and you decide to take a trade, how do you use your risk management to take a position? Do you have a strict amount per trade that you risk? How do you, using your risk management background, approach a trade once you have that technical setup that we've talked about?
Yeah, so let's make the assumption that we have a technical setup. It has a historical positive edge. Okay, so we all got that beside. We've
Mhm.
identified the opportunity. So now let's identify the risk. Right? as far as where I'm wrong, I want to know, okay, if price does this, I know I'm wrong. So I don't want just to have a certain fixed dollar amount or a fixed percentage. I'm not a big believer in that. My
Sure.
data doesn't support it. Find me the wall that I could hide behind. And if the market wants to come and stop me out, go ahead, market. Go ahead. You could win this one. Like we just talked about. Maybe it's the 618. Maybe
Yeah.
it's, something. I want to hide behind that wall. And again, I know it's going to happen sometimes where it's not going to happen. The market won't accommodate me. Now, when it comes to um, sizing, which is a very important part of the risk management, the enterprise program methodology or thinking, is I'm a big believer of having sort of what they call a graduation plan, where you start out very small, and then as you are successful, and we can measure it in many different ways, mostly by profit factor. I personally like to look at it that way, not really win loss.
Hmm.
I'll go up another quote unit, contract, whatever. Then I'll go up to a third, a fourth, then pull back to a second, third, fourth. This is like this two steps up, one step back. And here's the reason why, like from a risk management standpoint, is I'm protecting my risk of ruin. If this just totally goes out of control, markets change, I lose my touch, I don't know what happens, it's being done at a lower level. All
Yep.
right. I have my employees, they're my strategies. I'm going to promote the ones that are doing well, and I'm basically going to retrain or possibly even get rid of the ones that don't, and I'm not going to pay them as much as well. So,
Mm.
this natural progression of scalability and management of the sizing really is reflective of my risk of ruin plan, which really, in theory, is virtually zero. Because again, if things went awry on one strategy, the other ones will be working, and maybe this one, well, it will be at a lower level.
Yeah, I like that. And then that's another good analogy of having basically your staff is your trading strategies, and you promote the ones that do the most, and you sort of numb out or quiet down the ones that are not doing nearly as well. And that's a great approach. We've had someone on the podcast who had a similar approach. Courtney Smith, trading veteran, came on here and he talked similar to that. Having that idea of raising up your strategies that are doing better, and less of what doesn't work. And it's a simple concept as traders that we often come back to, is do more of what works for you and less of what doesn't. And that is sort of actually part of your risk management model to a degree as well. Like if you have something that's draining your account, that's obviously a bigger risk, so you probably want to do less of that and more of the stuff that's an asset to you. So very, very, very good stuff, Michael. Michael, I'd love to have you come back, and I'm sure we could go on for countless more hours. I'd love for you to come back maybe in the future. We could do another episode together, but this has been fantastic. Thank you so much for coming on.
You're quite welcome, Nick, and thanks for all you do for the trader community. You got a lot of big fans out there. Obviously, your success has been contagious, and I wish your whole group and yourself good success, and great to be on here for sure.
Well, thank you, and likewise. And before we wrap up, I just want to let anybody who would like to, I'm sure you're going to have a lot of new fans after this, how can they find you? How can they connect with you? And if they have questions for you, what's the best way to find you on the internet?
Yeah, I do a lot of work with Desire to Trade. So you reach me right there at michael.toma at desiretotrade.com. And if just I have a personal sort of traveling trader, I'm a big traveling trader. So you can go right at michaeltoma.org, where I just kind of journal a lot of my traveling and adventures in the trading space.
Absolutely. And you do some coaching as well, is that right?
Yeah, I do. Some individualized. I also oversee a family office fund, so I do a lot of oversight in that respect. But yeah, individual coaching, some prop as well. It keeps you honest, it keeps you humble, and it's certainly to be honest with you, Nick, and I know you agree with this, makes us better traders when we coach.
Oh, for sure. For
For
sure.
Kind of
sure.
a selfish reason to coach, but yeah, it makes us better
It
traders.
definitely
It
does.
does. Well, there you go, guys. Make sure to go check out Michael on his website, and again, if you're interested in coaching, he has some of that available as well. Michael, thank you so much for coming on. It was a pleasure.
Always a pleasure, Nick.
All right, thanks so much.